Good morning. My name is Naneji Opokwajman. I welcome you to the head office of Blackstar. Today is day 3 of the 2023 edition of the Blackstar Investor Webinar Series. We are still admitting our guest speakers and other participants. So like we did in the previous days, we will beg of you to allow for another 10 minutes so that we start at exactly 10 past 10. Thank you, and we'll see you in 10 minutes' time. Good morning once again, and thanks for sticking by. This is the 2023 edition of the Blackstar Investor Webinar Series. And this webinar series is a forum that brings together all players in the financial market for us to have discussions on matters that affects us all. This year has been what we call the reflective version, because we are reflecting on the stakeholder gaps and to see how we build back. We want to assume responsibility for everything that happened across various players to see how we can become much better and much resilient. Where this is day 3. The first day we had the capital market guys, and yesterday too we had the banking sector. Today, we are focusing on the insurance sector, and we'll crown it tomorrow on the fintech. Our guest speaker for today is the Commissioner of the Insurance Commission, Mr. Michael Andor. And he will also be joined by 3 other experts. I think today is the day of precedence because we are honored to have Mr. Seth Aklasi, who is the president of the Ghana Insurance Association, who will be on as a speaker. And we also have our very own president, Mr. Winston Nelson, the president of the GSI, that's Ghana Securities Industry Association. And we also have the MD of the Jamaican Stock Exchange joining us. She was built for yesterday. There was a technical hitch, but she'll be joining us later today. And we also have an in-house presentation from Blackstar. The moderators for today are Mr. Emmanuel Ishen and Na Louisa Nelson. So I will bring in Mr. Michael Andor. After Mr. Andor's opening speech, Emmanuel and Na Louisa will take over. So Mr. Andor, good morning. If you can hear me, welcome to Day 3 of the Blackstar Investor Webinar Series.
Good morning, and thank you. I'm glad to be here at the Blackstar Investor Webinar Series. As mentioned earlier on, I'm happy to make some brief some remarks, and we'll be available to take a couple of questions if there are, because I need to go and attend to some urgent issues that are currently waiting. So that is the how it's going to go. So reflecting on stakeholder gaps and rebuilding investor confidence post the domestic debt exchange program. Ladies and gentlemen, the domestic debt exchange program has impacted insurance companies in a variety of ways. So straight looking the direct impact, we can look at the solvency effect on solvency resulting from the impairment losses that had to be recognized in the account. Initial liquidity challenges, which is gradually easing. Perhaps something that may stay for a while and we need to handle carefully is the impact on policyholder benefit. So with these impairment losses that have been recognized, the impact on policyholder benefit, and as the bonds are marked to market, it impacts the policyholder benefit as well. And that's probably where the issue of stakeholder gaps come in. First of all, getting the stakeholders to understand and appreciate the impact of this in terms of marking to market and how it impacts the benefits of policyholders is an issue and probably a gap that needs to be filled. So there are a lot of the stakeholders who don't have a good appreciation of what it means to market and what its implications are, and therefore may lead to a lot of dispute and complaints and other stakeholder misunderstandings. So the need to go into that and get the stakeholders, some, especially those of us gathered here, may have very deep understanding of how these things work, but not all the stakeholders who are eventually impacted by their effects do. Ladies and gentlemen, the Ghanaian insurance industry has been making underwriting losses for some time and have been relying heavily on investment income to break even or even make profit. And so you can understand that now that DDEP came in, the investment yields have gone down significantly. And as has been made known, this is actually being used to recalibrate the investment yield curve. There is probably the need for the industry to begin to take a strategic approach to addressing the underwriting processes so that we could generate some decent profit from there and not to depend solely on the investment income. Even in the area of investment, the other issue has been what else is there to invest in apart from the government securities, government bonds and government securities. So the availability of assets, of securities to invest in is also another issue. And that's probably why, before the concentration in the government security, there was this concentration on the fixed deposits with banks and NBFIs. And then that led to some of the banking crisis and the high NPLs and the cleanup that happened. And then the attention shifted to government securities with higher concentration levels. So the issue now is how do we develop a more comprehensive investment market with securities that are suitable for the not just the insurance sector but the financial sector, so as to help spread out the investment, to reduce the concentration in government. Of course, concentration in any one particular basket is not optimum, is not ideal, and so there is the need to also pay attention to that, to ensure it also concentration on government securities, I think, also it crowds out the real sector, because then all the investment end up being in the government securities and the real sector struggles to get access to these funds to grow businesses and the economy. So I think going forward, that is also an issue that we need to attend to. Then, as regulators, talking for ourselves as the insurance regulators, we will need to look at our regulatory frameworks, the capital adequacy calculations, and the asset risk discount. It has been the assumption over the years that government securities are low risk, and so in calculating the capital adequacy ratios, the risk discount on government securities have been very low, or in some cases zero. I think that's another thing that we need, we as regulators together with the industry, need to work on and probably get to recognize the risks in all the assets that the companies invest in, so as to generate the appropriate response and to enable insurance entities to structure their investment portfolios appropriately, and having a good understanding of the risk dynamics and the impact on their solvency and capital adequacy ratios. So that being the general impact and the issue that surround the DDEP and the insurance market, what are the clear things that we need to work on? So some lie squarely within the ambit of the NIC, the National Insurance Commission, and we will work on that in consultation with the industry. Some lies in the hands of the investment market operators, and we need to collaborate and work on them together. So the first, they are not in any particular order, but the first of them is working to improve the bonds market, to widen the bonds market, a variety of instruments that are available on the bonds market to enable risk management and minimize the over-concentration in any one type of security, so that we can manage the risks and balance the portfolios, and also lead to spread out from minimize the concentration in government securities and spread out, so that it can have some positive effect on the real sector and also help the industry to manage its risks. As I have mentioned before, we also will need to work on the solvency and capital adequacy framework to recognize the real risks in the various assets and investment instruments, so that regulated entities will be informed in structuring their investments portfolios to enable them. And then we'll have to take a strategic approach as an industry to help to improve the underwriting and other processes of the industry, begin to put some measures in place to improve the profitability of underwriting. Insurance companies have two main sources of income: underwriting and investment. And as the investment front begins or as the challenges on the investment front have been made known or have been exposed by the DDEP, there is now more than ever an urgent need to attend to the underwriting processes, improve the efficiencies there, and improve the profitability of underwriting, so that together with whatever can be realized from the investment front, insurance companies can also aim at some decent profitability. Briefly, these are the initial remarks that I have to make. I will stop here for any questions or comment on this, and I will give further answers or responses to any of the things I have said, or something I should have said which I didn't say. I mean, could also be asked so that I can touch on it. So I rest here for any questions that listeners may have for me. Thank you.
Hello, good morning. Thank you very much, Mr. Michael Ando. We appreciate your insights on the key discussion today. My name is Emmanuel Ishen, and today I have the pleasure of moderating this meeting with Na Louisa Nelson. Na, how do you feel about today?
I think I'm doing okay. We had a very good week. Day 1, day 2, and today we're having day 3. And Mr. Ando has started very well for us, giving us a very interesting speech on how the insurance industry is navigating through these very interesting times.
Yeah, I think that the audience are also very, very active in this regard. They are interested in some of the things that are going on. And there's a question here, Mr. Ando. So here it goes. In some jurisdictions, insurance companies use fund managers to make their investment decisions. Should we not implement this in Ghana so that licensed fund managers manage the funds to ensure diversification and achieve the objectives of the investments of insurance firms? If you can take this question.
Yes, thank you very much. That issue has come up a number of times. And yes, it will be very appropriate, very efficient to have insurance companies use fund managers to manage their investment. The question is, should it be compulsory? Should this be legislated? Is it appropriate? I don't have any answers, but these questions have come up before. In fact, there was an attempt or an effort to work on this. There was once some consultancy work that was done, and there was a meeting at Best Western Hotel around the airport. I remember a few years ago, where the findings of the study that was done on this issue was discussed, and the question was whether to compel all insurance companies to use fund managers, and the discussion, the debate was very intense, and the next steps were supposed to be taken, but somehow it did not continue. But the point, what I would say is that yes, that would be very efficient and that would be very appropriate. But as to whether it should be compulsory, and then what will be the terms and conditions and what will be the arrangement, those are things that we could discuss. But certainly it is a possibility, and we could well look into that.
Thank you. Thank you so much, sir. I think there's one more question here, and that's how it goes. Do you think the government can, what do you think the government can do to enhance insurance penetration in Ghana? Do you think regulations regarding insurance as we have for the motor insurance?
Yeah, there are a number of things that can be done to enhance the insurance penetration. First of all, we need to do awareness. We need to create awareness and get people to not just to know about insurance, but to understand what insurance does for them, and that's the various kinds of insurances that we have, and why they should buy them. The other one will be to work on some specific insurances that could help to improve the penetration. So yes, even though our Insurance Act says that all items being imported into the country should be insured in the country, it's been quite a challenge implementing this. The NIC and the industry are consulting with appropriate stakeholders, but I believe that if we get some consensus on this and work as stakeholders, as a nation, to implement this, it will go to the benefit not just of the insurance industry, but to everybody. I mean, if an importer imports their goods, insures their goods with a Ghanaian insurance company, and there's a loss, of course, it's easier to approach the insurance company. You can just walk to their office, get your claim, as opposed to having some insurance company in China or Asia where even their documentation you cannot access. So that's one thing, working on the marine. The other thing is on the life side, the annuity. So there are a number of insurances, apart from general awareness to let people understand what insurance brings to the table and why we should use the various insurances to manage our risks. There must be also work on specific insurances to help us. Marine is one, annuity is the other one. People have started retiring under our new pension system, and they now have access to lump sums from tiers 2 and 3. And it would be very useful to build a well-functioning annuities market where these retirees will use the lump sums to buy annuities from insurance companies. And there are other, and then ensure that all the big projects that we are doing are insured here as the Insurance Act requires, that even when we are unable to retain much, we will retain a little that we can, because it will help us to build capacity and to learn to take more the next time. So yes, there are many things, not just one thing. There are many things that all of us can do to improve the penetration. And NIC is working on the things that, as I have told you, the things that we can be working on right now.
Question. Yes.
Yeah, thank you very much, Mr. Michael Ando. We appreciate your time with us today. A lot of people would want to know more about insurance, and I think we should take some time to also look at education. I think in the previous sessions, some speakers made mention of partnering with the education service to ensure investment penetration by way of education, both at the primary level, secondary level, and at the tertiary level. We appreciate your time with us today. Thank you so much. We'll just move on to the next topic.
Great. Okay. Thank you.
So our first speaker for today is Mr. Seth Aklasi, and he's the president of the Ghana Insurance Association. He has about 20 years of experience in finance and insurance, and he'll be speaking on the topic, the impact of debt restructuring on the insurance sector. Mr. Aklasi, if you can hear me, kindly go ahead.
Yes, I can hear you, and good morning.
Good morning.
Okay. I think that the Commissioner of Insurance has actually dealt with this impact of debt exchange significantly because there seems to be some overlap where I didn't really know exactly what was going to talk about. But I have a few slides. I don't know whether I could share what I have.
Yes, please go ahead.
Okay, all right, that's fine. But before I even go to my slides, I thought there was a question that was put to the commissioner and he answered it. I thought one other area he should have mentioned is that with respect to the role of government in increasing penetration, there is this issue of when you do the comparison between the various countries with respect to comparison, you realize that those countries might have higher penetration rates, but in reporting, which is a different situation in our market, they do not add like pensions. In other jurisdictions, people add pensions and they add their health insurance, both the private and the public. So the figures are not really standard. Even around us in the CIMA region where we have these francophones, they always add pensions and health insurance to whatever calculations they do to determine what the penetrations are. So I think that is one area that government and then for that matter, NIC could collaborate on to push through so that the reporting is standard and comparable to other jurisdictions. Thank you. I'll come down to the impact of debt exchange. I believe that for the past 2 days, there have been a lot of discussions as to what happened with respect to the challenges and having to go to the IMF and the approach that was adopted from the first memorandum that was issued up to about this time that we have finally tendered in based on a certain memorandum that was available at a particular time. With respect to the insurance industry, I did say that the commissioner had spoken about some of these issues, but directly, if we come to the insurance industry, our financial statements fundamentally are impacted in terms of profitability by what we call the underwriting profit, which is the technical aspect of the insurance, and then the investment income. And then secondly, the discount factors for assets. We would have subsequent slides that we're going to show those discount factors, and those have been mentioned by Kofi as well, but maybe a pictorial representation would be able to show us the things that we need to do to remain solvent. And those are directives from the regulator, which tends to actually compel insurance companies to be very liquid. When you talk about the discount factors for assets, effectively all they're doing is that your assets are discounted and your liabilities are weighted, so that as much as possible, there's no understatement of liability and there's no overstatement of your assets to give you a certain picture. But some way, somehow, if they are stress tested, then you could see a viable insurance company. So those are the two things that we would consider that has had impact on the insurance companies. We are reporting these figures as a result of the fact that I'd have loved to give a picture of the 2022 results, but then they should be audited. Because of all this process, there has been some delay with respect to the annual report that the regulator would have to release. And that is where we get all the verified figures. So we would limit ourselves to a large extent, excuse me, to these figures that have from 2021. So we're saying that the underwriting situation was that as at 2021, year end 2021, for the non-life companies, they have made a profit of about 31 million. For the life insurance companies, the profit, they made a loss, a negative profit of in excess of 400 million. And then it shows year to year prior to 2021 up to 2017. So you could see already that, okay, insurance companies are actually making losses. There are a couple of factors that we'll go into, but possibly one of the key issues is the pricing. Are we pricing well for the products that we are putting out? And then how are we managing our expenses, management expenses ultimately, and how it impacts on our figures? Despite these underwriting losses that have been reported over the period, you could see that the insurance companies have consistently made some sort of like profit after tax. When the losses are recorded from the underwriting side, by the time we get to investment, because we are having some investment returns, then at the end of the day, we are able to report profits after tax. Those especially was very good about the time that we all had a very high interest rates that were giving us good yields that effectively brought us in the long run to this debt exchange situation. So we'll look at the situation where we look at how our investment mixes and subsequently what our exposure to government is. But there's one thing too that we look at in insurance. Our margins are particularly very small. It goes again as to whether we are really pricing well and whether we're managing our expenses very well. If you look at the profit after tax of insurance companies, all of whatever is on this market, in 2021, the non-life companies made the 200 million, and then the life companies made 167 million. We're talking about the entire insurance industry. So we are already not particularly making a lot of money, as it were, even before the exchange had to come on. And if you look at the investment mix, as it were, for the companies, you see that a chunk of our monies are actually with the Government of Ghana Securities. In 2021, that is, we had about close to about 1.5 billion for, 831 billion, as at 477 in 2020. So those are the comparisons between the previous year and the just finished year. I said that we stopped these things at 2021 because these are actually audited financials from the various companies that have been reported by the regulator. So we do not have to show 2022 figures that are not being certified per what our regulator would have done. So you look at it that the deposits held by the licensed banks was about 554 million as at 2021. Equities were 511, investments in property 400, and then it goes down as to what other deposits and then mutual funds and other investments as it were. If you look at all these amounts of monies that you were looking at, the one held with Government of Ghana in 2020 was about 1.6 billion. In 2021, at the end of the year, 236 billion. If you look at the 2022 figures, they are definitely higher than these figures. You look at deposits held at the banks is about close to 1 billion, and then the equities is about 400 million, investments, and then other deposits and corporate debt and all these mutual funds. So I did say that from the beginning that the regulator applies certain discounts to our assets. I'd want to show what exactly is done. Then I bring you back to the reason why a lot of insurance companies had actually gone into the treasury bills and government bonds. Because if you hold government bonds, you're going to get a 0% discount on it. If you hold cash and term deposit at licensed banks or corporate debt, the NIC will discount it by 5%. And then if you are having listed securities, will be discounted by 15%, other securities 30%, money market mutuals 5%, land and buildings held as investment 20%, and then if you have land or buildings that you occupy, you'll be discounted by 50%. That I explained earlier that these discounted factors are actually applied because the regulator expects the companies to be very, very liquid. So in the case of where they say if you have an asset that you put on your books and you still occupy that asset at a building, they're realizing only 50% to show your solvency regime because it's not easy for you to move out of your head office even if you have liabilities that you need to sell that building to take care of. That is why those ones are weighted, those assets are discounted by this margin. So that is the situation. So if you look at those things, then it sort of like compels insurance companies to say that if you're going to meet the regulators' solvency framework, you definitely would have to skew your investments in a particular direction, which has been done by the insurance companies. So you realize that over 40% of the premiums that we had were invested in Government of Ghana securities. I mentioned that the NIC end of year report hasn't been, but if you look at Q3 Supervisory Department reports that had been published by the regulator still, we already in 2022 by third quarter, we were in a loss situation of 350 million Ghana cedis. And over 35% of investments by the insurance companies was held in Government of Ghana securities. We had in absolute terms by the third quarter invested about 4.3 billion in Government of Ghana securities. What does all this situation imply with respect to the debt exchange as as instituted by the government? Effectively, what it is that our investment incomes are significantly slashed down, considering that we said we were coming from a position of making losses as underwriters. we were now going to be stifled of cash because we were not going to have access to our cash. The tenure of the bonds had been increased. And as a risk management tool for insurance companies, anyway, anyhow, there should always be an asset liability match, where we are having liabilities that we have generated with some of them who are actually guaranteed benefits that we've guaranteed to people, taking into consideration the existing rates of returns that we design policies to sell for. Then we need to, as prudent underwriters or prudent companies in risk management, match our access to liabilities. But now we are suffering because we do not have that benefit of any guarantee of when our monies are going to come, and then how quickly they're going to come, if they're going to come at all as a result of this debt exchange. So that's how those ones have impacted on us. And the life companies have had a significant impact on their operations. I looked at some of the supervision department reports as at the end of first quarter of this 2023. If you look at those ones, the technical reserves that they'd have to build up between 2022 and 2023 moved from like 3.8 billion to 4.2 for the life companies. If you look at the asset base for the general business companies, it also moved from like 4.4 to about 5.2. But what we do not know is that what discount had actually been applied to this assets that the companies are holding on their books. For all you know, some people, based on what recommendations or agreements you've had with your audit firm or the Institute of Chartered Accountants Ghana, there is a range that had to be discounted. As to whether it's been discounted fully or we are waiting to discount. And this is a period that we are looking at the cocoa bills that are now also having to be exchanged for something else, then it's going to just keep impacting negatively on insurance companies. If you look at the claims that we are paying from 2022 first quarter for non-life, we had about 188 million in claims that was lodged. By the first quarter of this year, that alone has increased to 230 million. If you look at investment incomes, which are very critical, if you look by the first quarter of 2022, non-life insurance companies had made about 161 million in investment income. As of the first quarter of 2023, they have only made 91 million in investment income. And if you come to the life sector, it's the same situation where for the first quarter of 2022, they had made about 144 million, and then they've made about 100 for this. So the figures already are telling us to what exactly our situation is. What is making this situation even much more dire is that the emergence of the new accounting standards that we're supposed to report. It has a two-pronged benefit where one, if you're able to adapt it, it shows your position. But because if you adapt it and then you have to realize all your losses from day one and then make provision for profitability for other things rather than the other previous standards which we kept, which I'm referring here to the IFRS 17, then it's going to be putting a lot of stress on companies. What are we supposed to be doing? If we're losing money and we are discounting all these amounts, are we now going to begin to say that we'll have to call on shareholders to put in money, or on the surface of it, we just go down and do a proper underwriting? And how do we do the proper underwriting? It's by pricing. So if you are assessing the risk and you consider all the factors that you'd have to look at in pricing your product, then you know what margins that you'd have to put on it to be able to charge the adequate prices for the various products. And then as an industry, would have to avoid undercutting. We'll continue to educate the public to effectively know that no insurance companies are able to pay their claims and give them a lot more trust. You get to hear a lot of people say insurance companies don't pay claims. And if you ask them, oh, have you ever made a claim? And then they said, oh, no, I haven't really made a claim before. But you wonder exactly where that perception is coming from. So in the face of all these ones, the regulator did try to give us some forbearances to take some of the pressures off us. Chief among them is what I've actually put out here to say that they said they were going to give us a moratorium and not insist on the minimum capital requirements and then the capital adequacy ratios. But as insurance companies who pride ourselves as people who are risk bearers and risk managers, we basically would have to pay attention to these things, even if the regulator is not necessarily mindful and is giving you some sort of like moratorium. I think that even I mentioned the IFRS 17 that has to be adopted. Initially, it was purported to have been relaxed to say that, oh, we do not need to adopt it immediately. But just in the last 2 weeks, the regulator came back to say we would have to adopt it. So those are the difficulties that we face as a result of the debt exchange, where your assets are being discounted, you're realizing day one losses from day one, and then you're looking at profitability of your portfolios as you try to remain in business. Ultimately, how are you going to fare? Collectively, I think that the only thing comfort that generally we have is that previously we were supposed to have been paying our claims maybe in 5 days, but now we have like 15 days after discharge to pay the claims. So those are the little things that we have. And then we're supposed to have been keeping statutory deposits, which are effectively 10% of your minimum capital in an escrow account that we have with the various commercial banks that is controlled primarily by the regulator. We have been able to assess 50% of that statutory deposit if you are cash strapped, but those are all subject to approval from the regulator. And this important issue of government promising us that they were going to have a stability fund, we are not particularly clear as to how that is going to be, when it's going to be instituted, and how it is going to come out. I think that reasonably I'll stop here, and I'll be happy to take questions and explain the issues as it were. So thank you.
Thank you so much, Mr. Aklasi. This has been very insightful, and to think that the insurance sector is also facing some of the hits that the DDP has dealt on the entire country. To think that about 35% of the insurance assets are invested in government or Ghana bonds is quite intriguing. I think our participants, I'll have a few questions that I'll just put to you. I hear Mr. Michelando is still on the call. So Mr. Michelando, please feel free to chip in on the questions as well. The first question is, what is the impact of the capital on the capital positions of insurance firms, considering the fact that they were just about ending their recapitalization exercise when the crisis started? And are there any regulatory forbearances in this regard?
Is that for me or is for Mr. Andor?
Mr. Aklasi, you can start, and then Mr. Michelando can chip in as well.
Okay. I think that, okay, as an association, we do not necessarily have detailed information with respect to that. But some way, somehow, I think in a meeting, the regulator did intimate. I hope Mr. Andor is still around. He is the best person to speak to those ones. He indicated that I think there was virtually only one company that hadn't met the capital, but they had actually have some arrangement for them with some timelines. I'm not particularly sure about those ones. Yes, and then you see, in the later part of my presentation, I did say that yes, in spite of all these challenges and the minimum capital issues that we have, the forbearances have been given by the regulator, where they are saying that they're giving you a moratorium to say that if you do not meet the minimum capital of 50 million, they're going to give you a period to meet it, which is a 2-year period within which you're supposed to meet it. But because it's something that we're going to be moving into the adoption of the IFRS 17, where effectively, depending on the portfolio of risk you have, you definitely would have to look for capital to support your portfolio of risk. It's sort of like, okay, they're giving you something, but in actual fact, they are not really giving you. So what it is that if you think that your risk that you're assuming require a lot more capital per portfolio, then you would have to look for money to shore it up, because you need an asset liability match, or you need some solvency to be able to exist as a company. Granted that in the first 24 months from debt exchange from last year, I'm sure we are actually a quarter way through already. Then every company should be making sure that you're adequately capitalized to be able to be in a business. Otherwise, if you go report your financials, nothing is going to show that you're actually solid or liquid enough to meet your liabilities. So that's what I have to say.
Mr. Michael Andor, would you want to chip in a bit?
Okay, I'm on the road, so the internet connection is not very strong, but let me just comment briefly on this. So yes, you are right. There is a plan to help companies that had been impacted by the DDEP to capitalize. We would soon ask companies that have been impacted based on the report, the audited report they have sent, to submit capitalization plans. So based on the capitalization plan, some discussions will be done, and then some facility, the Financial Stability Fund that the government has talked about, is not just for the banks. There is some portion for the insurance sector as well. So that will come through. But as the GIA president has said, yes, the forbearance we have as a 2-year period for companies that once met their capital and prudential requirement and have been impacted by the DDEP, to be given a 2-year period within which to capitalize, either by themselves through the Stability Fund or any other intervention that will be made available. That is going to roll out soon. So yes, there's a plan to help the companies that need additional capital as well, and that will be worked out soon.
Thank you so much for chipping in, Mr. Andor. Another question here is to the president. Do you have a fair idea of the level of participation of insurance firms in the DDEP, and how is the regulator weighting the old and new bonds?
Yes. I think that as an association, as we engage with the GSI and then the Banks Association, we actually collectively decided to tender. I'm not aware that there is any company that has not tendered for the new bonds that are on the market now. So to a large extent, or to the best of my knowledge, all the insurance companies have tendered their bonds and are actually having the new bonds now. That is one reason that we said that we would have to wait for the audited financials to see the impact. I can only speak with respect to my company. I will not be able to speak with, to the issues of the entire industry, because I've not seen their data. But then the regulator, it's in the best position to be able to speak to that, to see that how is it impacted. And thankfully, Mr. Andor is here, so he should tell us how they are actually treating the tendered bonds and the new bonds that have been issued. But then what I know is that as at December 2022, because of the declaration alone of the debt exchange, all those bonds had to be discounted by a certain range, depending on the risk appetite of the individual companies. I think that the Institute of Chartered Accountants had actually agreed for their members, who are primarily our auditors, a certain range that you need to, a certain range of discount you need to apply to that. And depending on the corporate philosophy or risk appetite and risk management philosophy, some people actually took as much as 50%, or some people just took like 20%, some less. So that's the situation. Ms. Andor can help us to how they are treating the new bonds.
Okay, so there are two key things when it comes to how the bonds have been treated. So one is the accounting treatment of the impairment, and that was sort of prescribed by the Institute of Chartered Accountants, whose duty or mandate it is to regulate the accounting standards. So they came out with a guidance paper and recommended discount rates to be used to value the new bonds. And so that was used by all the firms. And when we received the audited financial statement, companies that we noticed or didn't understand how they had applied this, we had to go back to them, either ask them to explain or to apply the directives as prescribed by the ICAG. So that was used to calculate the impairment loss, okay, the impairment loss resulting from the DDEP. The second issue is, how are we treating them for solvency purposes? Because of the moratorium that we have, and because we haven't actually agreed on the new solvency framework, we are using what we have, but we are not going to take on or to penalize the companies which have suffered impairment because of this. So we have taken it at face value as it is. So for the accounting side, yes, the impairment losses have been calculated based on that. And looking at the industry so far, the impact has not been as heavy as we expected. There are a few companies that are heavily impacted, and we have been in touch with them. There are some that could manage it and with the assistance from the Stability Fund that we are talking about. But early days yet, still going to the discussions with them. At this stage, I have to go into other ceremony I talked about. So on this note, I would like to thank all of you and wish you very well. I need to check out at this stage. Thank you.
Thank you so much, Mr. Andor. We appreciate your time with us. Mr. Classy, there's one more question that you can take for us. It's about insuring investments. Are there any plans of such products on the market?
I didn't get that question. Insuring investments.
Investments, yes.
I'm not sure I get the question very well, but then I mentioned that the what we call like guaranteed policies. The life companies all do have investment-linked policies. So you effectively buy a policy that gives you returns over a period. And those are the ones that we refer to as guaranteed policies that have actually been impacted to a large extent by this debt exchange. I don't quite get the question, but if that is what it is, that's my thought. Or I don't know whether you're asking whether if you go ahead and then you buy an investment, do you have any insurance for it? So I'm not very clear about the question.
Yeah, I believe it's the latter. So the question is, can you take an insurance policy on your investments? Yes.
For insurance, the insurance is a game of numbers. Currently on the Ghanaian market, I do not know of any such policy, but we keep on evolving. What it is that on the surface of it, insurance companies always have a lot of support behind the scenes where we buy reinsurance and reinsurers buy retrocession and that kind of situation. And for me, I believe that for every insurance product or every request, there is a price for it because we do actuarial valuations to see when will the loss occur and at what point do you think you'll be called on to pay an X amount or Y amount. But on the market now, no. But if there is need for it, I'm sure somebody would actually be able to design such a product for it. Might be mindful that culturally, we don't necessarily like buying insurance in this part of the world. Thank you.
Thank you so much, sir. We'll just move on to the next speaker, but we would appreciate if you would stay on the call so that any further questions that come in, you can take them for us. We'll just move on to our in-house presenter for today, Nan Louisa Nelson, who will give us a brief analysis on the insurance sector.
Thank you, Ishan. Just give me a minute to share my screen. All right. So basically, we just wanted to understand a bit about our insurance industry, just to see the trend that has been occurring over the past few years. So this is just a short presentation about Ghana's insurance industry. So our usual disclaimers, we try and make sure that everything in our presentation is on point, but just in case you'd want to use the information, kindly verify for yourself. So our main topic and our main theme for this webinar is reflecting on stakeholder gaps and rebuilding investor confidence post-DDEP. And so we centered our presentation on this topic. And we want to start with understanding what really has been the news of insurance over this year. So basically, we've seen that we've had some headwinds in the insurance industry, and various sectors in our industry have faced these headwinds, mostly the domestic debt exchange program that we've all been talking about. So you see that we had some news on the insurance industry taking very huge hits in this exchange. We also have one of the interesting headwinds that we've been facing for the past few months, and that is sticky inflation, how high inflation has gone. So you have some news on car insurance companies increasing their premiums, and because prices on the market have gone up, so they have to increase their premiums on that. So all this has led to low economic activity, and we are really seeing it also felt in the insurance space. So we want to just understand basically what really goes into insurance. And one of the key things when we're looking in terms of the research is understanding the premium. So understanding how premiums have grown over the period. So basically insurance, life, non-life. I know we have a lot of insurance aspects on the call, so I won't dare give any definitions. But in these terms, so we're looking at both life and non-life insurance going into gross premiums. So over the period, we've had non-life, and non-life is the white line. Life is the blue line. So we've had over the period, non-life premiums grow higher than that of life. But if you realize in 2022, we've had them almost come apart, and we don't have the 2023 numbers because they haven't been published yet. But over the period from 2010 to 2022, we've had life insurance averagely grow in terms of premium year on year by 26.4% and non-life by 22.8%. And we got this data from the National Insurance Commission. So you can see the sources down there. But in terms of if we want to consolidate both life and life insurance, so we've had from 2010, we've had premiums, gross premiums collected grow by 13 times. So we're comparing 460 million cedars to 6.4 billion. So that's 13 times in terms of growth in collection of the premium. And if you look year on year, it means that year on year is growing about 24.3%. And we asked our question, well, what is driving this growth? Looking at the different sectors involved in both the life and non-life. So if we pick non-life, we broke it down in the various components that go into it. So fire, motor, personal accident, marine, bonds, liability, engineering, and the others. So in terms of the breakdown, over the past few years, yes, we've had motor insurance be the major contributor to the growth in premiums. And we know that because that's probably because of the law that every car should be insured. And about 49% of it goes into, so if you realize just averagely about 49% goes into motor. And then the next one is property. So about 25% averagely over the past few quarters, so goes into fire and theft. So we have averagely year on year growth. In fact, quarter on quarter growth since 2021 for fire being around 54%, for motor being about 37%, for personal health and medical going up by about an average of 34%, marine 44%, bonds, financial guarantees growing about 51%, and then engineering growing about 55%. In terms of life, universal life and investment products are the largest contributors. So it takes about 34% of the premiums that are paid, and it's followed by term. So you see that universal is the deep blue down there, and then term is the green, and whole life is the ash. So we have year-on-year growth for term about 29%. Group life averagely over the past few quarters have grown about 28% quarter on quarter. Whole life has done about 26%. Credit has done 25%. And then the others, which are made up of dread disease, annuities, and other approved products, grow about 22% year on year. So in terms of the changes, and I know both Mr. Ando and Mr. Classy mentioned requirements, that the capital requirements, that the exercise that just happened. So just looking in terms of how that has changed. So with the various sectors, with the various segments of the participants in insurance, we have the insurance brokers, we have the reinsurance brokers, and then the actual insurers, and then the reinsurers. So for the insurance brokering companies, loss adjusters, and technical services providers, we had their we had them around 35,000 in terms of their minimum capital, and it increased by 66.7% to 500,000. Reinsurance broking companies didn't have their minimum capital change, so it stayed at 1 million. But the most impacted sectors or participants in the sector were the insurers and the reinsurance companies. That grew from 15 million in terms of capital to 50 million, and that is around 3.3 times their initial capital. And reinsurers had to also show up their capital by about 3.125 times. So from 40 million to 125 million. So if we want to look in terms of how assets in our financial industry have grown, so insurance companies are, yes, of course, part of our financial sector. And we looked in terms of categorizing each of the sectors. So we have the banks, we have the pension industries, we have securities industries such as ourselves, and the insurance industry. And you can see here that the insurance company, in terms of asset growth, contributes very little, around 3 to 4% of assets per year. That's since 2014. We've had the banks contribute most of it, and of course, they have most of the deposits in the industry. But what I wanted to notice was that asset growth in insurance companies have actually quadrupled. So it has from 2 billion in 2019 to about 9 billion in 2021. And 2022 and 2023 numbers aren't out. So we just have for 2021. So it's grown about 4 times, even though the base was 2 million. That's very small. And that's why you won't see that it has contributed much in terms of asset growth to the industry. But in terms of banks, so banks have grown about 3.25 times. That's from a base of 60 billion. And we're almost at 200 billion. I'm sure we are even past that by now. And pension funds have grown about 3.95 times. So that's close to about 4 times. And then the securities industry has grown about 1.9 times from 2014 to 2021. So just looking a bit, zooming in at the insurance companies and understanding their investment holdings. So how have they grown over the period? So for the past 10 years or 12, thereabouts, we've had them grow about 7 times. So we've seen the growth over here. So from 1.1 billion all the way to 8.9 billion. And I'm sure their holdings are still increasing as we speak. So in terms of average growth, we've had about them grow averagely year on year 26%. But if we break it into life and non-life, so averagely, life has grown about 28% year on year, and non-life has done about 32%. In terms of the growth we see in the industry. And just zooming in a bit at just 2021. So this is a breakdown of the investment securities that we see mostly on the investment companies, the insurance companies' balance sheet. So in terms of their exposure to governments, we can see that this is a very high exposure to government. That's about 2.4 billion for the life insurers and about 830 million for non-life. So life insurers are heavily dependent on government securities at the moment. And the rest, we have them in FDs with banks, and then just a little goes into equities, investment properties, other deposits. And we see the list go on: corporate debt, related party investments, and then mutual funds, sorry. So just looking in terms of the spread, how they've invested in government bonds since 2017 to June 2023, and this data is from the CSD. When we say short term, we actually mean between 91 days to 2 years. So that includes the treasury bills. So 91, 182, 362, 364 to the 2-year bonds that we see on the market. So insurance companies have reduced their holdings. And if you see from the ASH, as I draw the line, you see that the holdings on the short end has actually reduced over the period, but this year it increased a little bit compared to what it has done over the years. So from 2019 to 2022, short term was around the same. They had the same exposure for short term, but in terms of medium term, that's from 3 years to 6 years, we've had them decrease their exposure a bit, but not as much as they did with the short term. The insurance industry has been more long term, and if you realize currently they have about 43% of their holdings on the long end of the curve, 31.23% on the medium term, and 25.24 actually on the short term. And I'm quite certain that in the long term, we have a lot of the life. And if we just go back one slide, you see that life really is quite heavy on GOGs. And I'm sure they have a long investment horizon, and that's why maybe we might see them quite heavy on the long side. So the question we've always been asking ourselves is, well, a lot of sectors have been exposed to this DDEP, but one of the sectors that have really had an impact is the banks. So the question is, how exposed is the insurance industry to the banks? And we looked at that from the BOG's data, and they mentioned that the insurance institutions are quite exposed among the SDIs, among the securities industry, among pension companies. Insurance institutions are quite exposed to the banks, but when we switch it, insurance companies, the banks are not as exposed to insurance companies as they are exposed to the banks. So as we keep on looking at what's happening in the banking sector, especially with the next restructuring that is going on, that with the cocoa bills, with the local dollar and the euro bonds, is quite interesting to see how that might impact the insurance companies. So lastly, I just want us to look at the profitability of the sector. So profitability has grown for the past 10 to 12 years. So we looked at the data from 2012 all the way to 2022. And last year, they posted quite a healthy profit of close to 460 million. I think their highest in the past 10 to 12 years. So the industry is profitable. And I remember Mr. Classy mentioned that a lot of the investments that they do are used to shore up some of the losses that they make in underwriting. So it'll be quite interesting to see how this position changes moving forward. So basically, what we've been trying to do in this webinar is to really ask what is next for the insurance industry. And that's why we brought on all these experts, Mr. Andor, Mr. Classy, and we'll be seeing Mr. Winston Nelson and Dr. Forrest going on in the next presentations, just giving us what really is the next we'll see in the insurance industry. So this is just a short presentation from us. If you have any questions, I'm sure Mr. Classy is still on the call and we'll also handle those questions. So thank you very much.
Thank you so much, Na. That's very insightful. And the narrative has been very interesting. Mr. Aklasi gave us some tidbits on the position of the insurance sector, and you just summed it up beautifully. Thank you so much for that. I think there's one question here. Mr. Aklasi, you can take it. So you mentioned that most investments are in GOGs, and for good reason, because of the zero discount. Given the new developments, are insurance companies looking at further diversification, both domestically and internationally?
I think that is a very necessary thing. I think in my presentation, I sought to say that to a large extent, because we are a regulated entity, we are also still dependent on what the expectations of our regulator is, because we need to be compliant. A chunk of the money we handle is policyholders' funds. If you just oppose the shareholders' funds to policyholders' funds is way above what shareholders bring to the table. And then because the public interest has to be protected as well, the regulator is not just going to leave individual companies to invest as it were in any place that they want to. Then you could begin to have all these related party transactions that over the period has not necessarily worked out very well. So we are also dependent some way, somehow. In our previous discussion of the last time this issue came up, everybody is cautious. The regulator has not stuck its neck out yet, but we are also treading cautiously. Genuinely, the investment climate is a bit touchy. So we are all waiting and watching and counting our little monies, and we do not want to count the chickens before they are hatched. So we are all cautious. This is the time for caution. But yes, definitely there's diversification and there's need to diversify. But collectively, no, we haven't taken a decision as an industry how we want to do it yet.
Thank you. So just a follow-up on that. So is it an issue of the regulator opening up its sort of limits so that the insurance sector or insurance companies can take some exposure in some other, maybe international securities?
Yes, you see, that's why I mentioned that the regulator's role is very important for the main reason that it is people's money. It is policyholders' funds. Yes, if they give the indication, we would be able to effectively open up our investments and there into other spaces. I think earlier on when Kofi, the commissioner, presented, there was a question as to whether the funds, whatever, company should not be managing our investments for us. And then he said there's been some discussions in the past about all those ones and that kind of situation. Maybe we need to consider it that, yes, if we said we are professionals, let's focus on our core business and get fund managers who are professionals as well. However, I'll hasten to say that now, the fund managers, who takes the liability if they then now go out and then invest like just happened, assuming you had a fund manager that had exposed you significantly to government of Ghana, who do you blame? Do you blame the fund manager, or you're going to blame the government of Ghana if you are losing money? So I think that we are in a transition. We would definitely have to just take our time gradually and look at the situation and then come out with the proper policy directives and the way forward. Thank you.
Thank you so much, sir. We appreciate your time, and we hope that you stay on the call till the last speaker finishes. We'll move on to our next speaker. So our next speaker is Mr. Winston Nelson Jr., the president of the Ghana Securities Industry Association. He's an investment banking executive with extensive experience in business startup, growth strategy, client coverage, deal origination, team building, and management. During the past 12 years, he has contributed significantly to the value of growth of Ghana's capital markets, and more recently, the West African capital market integration process. He will be speaking on the role of the GSIA in advancing stakeholder cooperation towards financial markets revival. Mr. Nelson, if you can hear me, the floor is open for you.
Thank you very much. A very good morning to you, and a good morning to all your listeners who have joined us today. It has been an interesting conversation. As I sat down, I think I've had some insights into what is happening in the insurance industry. But what is critical is that what they are experiencing, almost the whole financial sector is also dealing with the same set of problems. We've had the issues which are quite similar in the securities industry happening in insurance, happening with the banks, and then also happening with pensions. Thank you, Black Stars, for inviting me to speak on how we can build back better, essentially. It has been something that is on everybody's mind, given the problems that we have faced. And I wouldn't say only with DDEP. We can trace this back to the banking crisis, the recent one that started somewhere in 2017. The problems are quite similar. We have investors' funds. Some way it was allocated to a certain class of assets. That assets get into some form of a trouble, and then it spirals, and then we have to resolve we have to find a way to resolve the issue. Just when, for us in this space, just when the banking crisis issues were being resolved, then we get into a situation where we have this DDEP. Today, just for me to share what the GSI is doing currently to ensure that we build back better, to ensure that the investment space become more robust. As you can tell, almost every other industry kind of feeds into the securities industry because everybody has to invest. Investment, as I like to say, it is one of the laws of life. If you live your life and you consume everything you have on the same day, your life will be very short. So for us in the securities industry, given what has happened, we are looking at 5 key things, 5 key pillars that we are trying to use to build back better. I'll try and share my screen so that I can talk you through these 5 key things that we are looking at. So for us, the first thing is to understand the problem. I think this morning a lot has been said about what the problem is or what the problem has been each time we get into these crises. For us to understand, to be able to properly situate what is happening, we have to be true to ourselves, and nobody or all the stakeholders that play a role in this space in the financial sector should have a thick skin and accept that this is part of what the problem is. So you have first of all, you have a
Hi,
combination.
Mr. Nelson.
Yes.
Yes, please, do you mind putting it on presentation mode for us?
Just a minute. I'll just reshare in presentation mode. Sorry, just 1 minute. Let's share the screen again. Presentation mode now. Has it come through in the presentation mode now?
It's fine. I think it's fine.
Okay, sorry. Okay, so first of all, we were trying to understand. I was talking about understanding the problem, and for us, the problem or the big issue on the problem was you had a government that had a huge appetite for issuing debt. Despite all that was happening, there has been several warnings. We were told that your debt is going over. There are known parameters. There are benchmarks across the world of you not doing more than 50% of your 55% to GDP. We had bridged it, but we kept investing for about 4 to 5 years now. You could see, if you look at the balance of payment, it was quite clear what was happening on there. The trade balance was positive, but there were problems with the current accounts where you had, especially on the investment accounts along that side. So we saw it, and if we looked at the data pointed to the fact that there is a problem here. The second aspect of the problem was that you had investors who would not consider any other thing apart from high yields. So these two come together, and then it just becomes a very potent combination that can fuel a crisis. Naturally, you have capital market operators in between who were also torn in between investors demanding that this is what I want, you have to get me a better yield, etc. And until they get that yield, they put pressure on fund managers to also ignore certain principles of finance. Even in the pension space, where the pool of funds was quite stable and was growing at a very fast rate, we had issues where you could clearly see that the pension funds, whether it was the trustees or the fund manager, ignored almost all principles of finance. Portfolio theory was thrown in the bin. People could invest 70% of all their funds in one security, government debt. You had a regulator that sometimes people can even write to breach, ask permission to go over what they had invested in terms of the upper limit, to breach the upper limit of what they themselves have prescribed in policy guidelines, and they would approve it. So these were some of the things that have happened. That is it. It is what it is. We all have to appreciate, understand the problem, agree that we contributed to this problem that we currently face, and based on that, what do we do? And I believe that is where I don't want to focus too much on the problem. I think we all know what it is, but just to scope it for all of us, I think that it was very important to rehash what the issues were for us to look at how we can get out of it. When I start to present on what we, as the governing council of the GISI, is looking at what our plans are for, how we can get our industry out of it, at least then you have the pack. So the next thing I would like to talk about is behavior change. The crisis of 2017 and the crisis of that we have now, you could see is seriously linked to adverse behavior. I mean, both from the investor, as I've said, both from the investor insisting on high yields, both from the intermediaries, whether they were fund managers or corporate trustees, etc., also going along with that. and definitely from the government of Ghana in terms of how it's managing the economy, interest rates, trade-offs, all those other factors that come to play. We all have to agree that this is not sustainable. We cannot afford another crisis within a short period of time, because currently what we find ourselves in is seriously challenging. You have investments, people, pensions, etc., are illiquid. The markets have almost ground to a halt. We will be hitting a year where we really haven't seen any significant market activity, whether in the bond market or in the equities market. So we have to go back to basics. We have to go back to basics. We have to start to respect the principles of finance. When we all sat in finance class, we were told that there is a traditional way of constructing a portfolio, 60-40, very traditional. These days, it has evolved where you consider other asset classes as well. But the traditional 60 equities, 40 debt, and these days it has evolved where you mix it a bit. And we have to start looking at going back to basics. How do we construct the portfolios? We are not the first people who are doing portfolios that are taking care of people's monies. So we have to go back to that point and relook at how we do some of these things. Assuming the whole industry or even the whole financial sector was only about 30% invested in government debt, the results or the impact of what we are seeing today in terms of on investments, on liquidity, on capital markets would be much muted than what it is today. Currently, what has happened because of we were holding the wrong side of the stick. We have only amplified the problem that has been presented to us. So investors have to go back to basics. Intermediaries have to go back to basics. And the government itself must also know that once we go through this crisis, people will not necessarily be as much accommodating as they have been under these crises, especially within a short frame. A short frame. We cannot afford to go have another crisis in the financial sector. It probably will that probably may be the last nail in the coffin. Best practices, regulators now have to look at best practices and try and enforce it without fear or favor. I like to give the example of the mark-to-market. For many years, we have been talking about mark-to-market, many years. But for some reason, we all try to get around it by saying that, it's not necessary. We can do without it. So you had almost all the pensions, securities industry, and maybe insurance. We had all bought government bonds, and then we never changed the price on our books because we always believed that it was risk-free. And now when this crisis starts to happen and we see that these bonds start trading at steep discounts, marking to market was a big challenge for even us to explain to investors. From an association point of view, we had to go on radio. You had the Director General and the GSI on radio trying to explain to the public what mark-to-market means, what you have to do. You know the stories about some of our members having to shut down their offices to work from home because they cannot face investors who said, this is the money I have with you. You sent me the statement. Now, why are you telling me this? Because the communication over a period has been wrong. Telling them government is risk-free. If you buy bonds, you never lose the money. Now, I think that we have all come to realize that, you know what, we have to improve on the communication. Let's go back to best practice. Regulators, when they set up an upper limit, it is for a good reason. They must ensure that they do not just be giving waivers for people to breach those limits just because they write a letter to you. We cannot afford that. It is all of us are monies. Regulators have to go back to the basics of ensuring that the principles of finance are respected. If you are constructing a portfolio, let's construct a portfolio properly. So these are some of the things that we can do to change behavior. For us as an association specifically, I think that we are going to go back to something we have discussed for many years, but we have never been able to get our members to do, which is the Global Investment Performance Standards. I think these kind of standards that create a level playing field, how we report returns, how we do all the financial reporting, etc. We must standardize it. The association was at the forefront of trying to get GIFIM to come up with closing prices that we use to do the mark to market. So just to get a common standards. Naturally, this was introduced at a time where the fixed income market was a bit choppy. So it became difficult to get people to, should I say, comply, because today the prices are here, tomorrow the prices are there. But this is something that we probably should have done 5 years ago, and we should have insisted that mutual funds, portfolio managers, etc., mark your books to market, use this price. It's not too late, it has come, the crisis has triggered it, but hey, at least we have added on to it. So a lot of, for us as an association, I think that a lot on our mind is how do we set standards and enforce and get our members to comply, working with regulators, of course, to get our members to comply to these standards. Because once everybody is in line, it's easy to enforce good behavior. When you get a few people doing the right things and you can get a few naughty ones doing the wrong things and everybody starts to see the profit, it's always difficult for you to convince those who are doing the right things to stick to doing the right things. Also, some of you may be aware that the SEC has issued the self-regulatory organization guidelines. I think for us as GSIA, we are looking at the SRO critically. It's been on our drawing board for a while. We've discussed what kind of models we can use to become an SRO. And if currently we are at the stage where we have to do the business plan, find the funding, and then apply for the license to become the SRO. The key thing, why do we want to be an SRO, would be some of the things I've said. At least we believe that amongst our members, once you start to enforce standards, once you start to enforce minimum requirements, once you start to not only, once your membership knows that you as an SRO have certain enforcement powers, it changes the game. It forces, should I say, it reinforces behavior. We all move into some form of center. We can have the discussions because it's an association of members. But once it is set, we all know that this is what we all have agreed and you have to comply. Currently, once there are no such powers, people are free to comply or not. So in terms of behavior change, these are some of the key things that I think that from our point, we are looking at, okay, how do we change behavior? How can we get our members to behave properly and towards reviving the market? Nothing lasts forever, as you have seen, as I've written up on the slide. Nothing lasts forever. We will one day you're on the mountain, the next day you're in the valley, but we believe we'll go up the mountain again. But this time around, we have to go there more resilient, more robust, and better prepared, so that we do not go every, should I say, 5 years or every 10 years, there is one crisis that comes to wipe out all gains that we have made. The next thing I would like to talk about is, which is also focused on bringing the revival, is that there should be new products and innovation. I've heard from members a lot, and I think this morning I've also heard it, when you ask people about investments, the issue that comes up is why they are not diverse products. The market is not liquid, the market is not deep enough. These are the three common problems that people always say to us for why we like Government of Ghana bonds. Of course, the yield is there, but I think the high yields also is very attractive given the environment we find ourselves in. But as an association, we have been working with the Stock Exchange, the CSD, and the SEC for some of the problems that we have identified, so that we will start to resolve some of them. So in terms of How do we bring new products? How do we innovate? I think somewhere last year, there was a number of things done at the stock exchange level to improve the market, whether it was the fixed income or the equities market. All were geared towards let's improve, let's see how we can make the market more deep. So it's depth, it's liquidity that we were, and then some uniform standards that we were trying to fix. So in terms of how do we, some of the programs we were considering, and strangely, just before the DDE became, we had developed a benchmark program, which we were discussing with the Ministry of Finance on how we can have a benchmark program for the fixed income market, because at that point, look, there were 62 bonds. We have seen countries where the financial markets are deep, like a Singapore that had just under 12 bonds. And despite they having that, the market is so deep, all the major international banks are there, the amount they trade. So from lessons from those types of market, we started to work towards the benchmark program, which was done, which was planned. We were planning to shrink the bonds to, I think at that point, under 10. We're looking at between 8 and 10 bonds, etc. So that was presented to the ministry. We started the discussions, and then DDE became, it's been shelved for a while. But I suspect that when all these things go through, it will come back. This recently, I'm sure if you are within this space and paid attention, you would have heard about the commercial paper market, which was launched by the stock exchange. Well, it was just, should I say, pre-launch, because the SEC has not yet approved the program. But it's one of the key things where we thought in the short end, between 14 days to 364, we can have a program that will be run to bring more structure to the short end of the curve in terms of issuance, in terms of trading of short-term paper, to be able to structure that space properly, so that at least that also adds as a component to the market going forward. I think that is planned for most likely before the end of the year. That should also add to the market as well. There was trying to get the index, trying to build an index for the fixed income market. There were discussions with S&P on that project, because we believe that if there is an objective index in the market that everybody believes in, everybody subscribes to, it can lead to new product development. It opens up a new door into different products, index funds, along those lines, etc. So that is also in play, but naturally, the way the market has become so fragmented, it also has to wait until all these exchanges are complete, the market gains back some structure, and then we can get back to that. Currently, there are new rules that are being worked on as well, then to help the market in terms of the liquidity. So key among them is the new securities lending and borrowing rules that is being developed in partnership between the stock exchange and the SEC. Then you have the market making rules. There's also the margin trading rules. So these are all being sponsored, I think, under a World Bank program, but it is an AFDB, I believe, AFDB. And there are consultants who are working to develop these rules to bring to the market. One of the biggest challenges that we faced as an industry in terms of the securities industry, maybe the insurance also faced the same issues, was when that exchange came through, there was nobody to provide liquidity for the market. There was nobody to buy our bonds. There was no lender of last resort, etc. And naturally, that is how capital markets are, or that's how securities industries are. But we have seen that in the US during the COVID times, even the central bank got into buying mutual funds and providing liquidity for funds, etc., because of their size and the important role they play in the financial mediation space. This has not happened here. but at least things like lending and borrowing can help the market become a bit more liquid. Not necessarily even in the crisis, but it improves the liquidity challenges we normally face in the market, whether it is for corporate bonds, whether it is for equities, or even Government of Ghana securities. So these are some of the things that are being considered to help build back better, to help revive the market, to help help us climb up the mountain again once we go on our way up. Then I would like to talk about the influencing policy. I think if it is anything DDE has taught us, it has taught us that we have to become a strong and an effective lobby. As an industry association, you have to work. You have to work at your lobby skills. Okay, you have to learn. You have to formally learn how to get things done if you want policy to support you. We are not working in a vacuum. There are things that sometimes the government wants to do. We find an example is that now it needs money. So almost all sorts of taxes are being introduced, etc. Taxes that had exemptions to grow markets have been repealed. And sometimes it's so difficult that all you can do is just write letters or go and see the ministry about it and nothing gets done. For us, one of the key things, and it affects all of us who do investments, one of the key things is the exemption on the capital gains tax that has still not been extended. This thing is still hanging over our heads. We need to get this thing done. We have done GSI, Stock Exchange, SEC, we have met the ministry, we have gone all the way to Parliament to do our best to get this thing done, but it is still not done. I think that we all have to sit down and reflect on, learn new skills on how we can influence policy. Without us being able to influence policy, influence direction, and sometimes it's not necessarily for our own self-interest. It is for the good of everybody. Today, if there's no capital gains tax, it does not only affect us positively, even for the nation, it affects us positively, because a fund manager sitting down is looking at Africa as a portfolio. At best, it will break it into regions. If you come to West Africa, we are the only market now that has a capital gains. So imagine anybody doing an investment that has to deal with USD depreciation, then has to deal with capital gains. It is no brainer where they will pack their money in. They will pack their money into. So these are some of the challenges that we face. In terms of the next thing about influence policy would be, how do we work together as financial sector associations? And on this particular score, our hands were forced under DDEP to come together. That was not how it started initially, but down the line, we came together as Ghana, the Bankers Association, the Insurers Association, and then the GSI came together on a common platform where we started to discuss issues. We started to consider how we can influence the original DDEP that has been presented to us and how we can change it. So that has to continue. Because down the line, like I have said, anybody who has surplus funds tries to invest it. And once you invest it, you jump into the securities market. And once, so we are interlinked more than we know that we are. We have to recognize this. DDEP has taught us that we have to have a standing group, a standing committee, whether in whatever form that we agree, that looks at these issues. Sometimes even influencing the policy, we have to influence it together. If today we get a waiver on the capital gains tax, it does not only affect people working in the securities industry, and the insurers who have generally breaking through on the side of their investment income. This is one of the key things that can also affect their profitability. So in terms of the associations within the group coming together, working together, having a common approach, fighting common causes, cooperating to get things done is one of the key things that going forward, we believe that we have to continue to do. As I said, we did it under DDEP, so the framework is there already for us to do it, and we can get this done. Then sometimes it's not always the always you trying to influence policy in the sense that you have to write letters, do meetings. Sometimes you have to take action, okay? And you have to take action. Sometimes it helps if the action is coordinated. And I like to refer you to, without talking too much on this point, I like to refer you to London, what happened when Chancellor Kwarteng brought his policy. The market, I'm sure they did their usual trying to influence policy, but when it didn't work out, they had to trade them out. You know, they had to take positions that will show that we disagree with these things. And some of the times we have to also start looking at, these are some of the things that we can, because we also have, we are just intermediaries. We hold assets we hold assets in trust for people. We are managing things. We are directing people who also have expectations of us. So it is not always that once you approach and nothing gets done, you fold your hands. Sometimes there are market actions that you can also take. Sometimes you can sell out. Sometimes you can refuse to participate. So all these tools have to come to play to influence our direction on how we go forward from here under influencing policy. And then the last thing I want to, or the fifth pillar in our approach to how we are going to deal with how we are planning to build back better will be engagement with stakeholders. I believe ever since I became the president of the association some 2 years ago, the last quarter of last year and I think the first quarter of this year, I have done more meetings than I have done in my life. Almost every time we're almost at the ministry, speaking to the Ministry of Finance, trying to get something done. You know, we have to, all of us as financial sector associations or players through our associations, we have to find a way to have regular engagements with the ministry. If the finance sector is growing, we all benefit, including the government of Ghana. So our policy or our way, our engagement with the ministry, whether it is through a common platform as we did under the DDEP, must happen. We must have it on a regular basis, not only in time of crisis, but at least if once we as associations keep talking and common positions come up and we approach, I think that it gives more weight. There's more weight in the numbers, and then we can. It enhances the engagements that we can do, at least on the national and the ministry level. For us as capital markets, I believe that, yes, we can improve our engagement with the SEC, but generally we have had a very good working relationship with the Securities and Exchange Commission. We almost through their sandbox program where new rules, regulations are coming to them. I don't think a month goes by where the Secretariat or the executives of the association do not have any form of engagement with the SEC. So that is there, that is standing, but sometimes even we together with the SEC are not able to get the outcome that we want. But I believe that we will keep talking. We will enhance we will try and enhance, we keep improving how we engage. We keep improving how we work together to be able to achieve the common good. Of course, there are other regulators that we probably will still need to work with, the Bank of Ghana, on different types of things, whether it is we going through doing repos, building GIMRA, how Bank of Ghana's, how they get to work with our regulator in the securities industry, etc. So these are standard things that we believe that we can do. Of course, I've mentioned working with other associations. And last but not the least, we have to be able to influence our biggest funds, which are the investors. So for us, people come to us, those who use our service, those who consume our services, not only in the securities industry, but almost all of us. We have to be able to start working towards creating a platform where we can reach our members seamlessly, communicate better, improve financial literacy, bring them along so that it's not always that they push us to go chase yields. We have to be able to explain to them that if you are building a portfolio, you have to break it into these kind of parameters. And for these sets, don't go chasing yields. Over time, you will see the results, etc. So the investors are very important. They are critical. I believe that currently almost all of us work in silos. I'm talking about associations trying to reach investors in one way or the other. We also have to see what will be the common, especially given what has happened. You realize that when this thing happened, then we're forced to interact with our investors a bit more because they were calling us, they were giving us pressure, etc. So these are some of the key tools that I believe that we have to consider carefully as we move towards completing, at least maybe the domestic side, start to rebuild better and moving into the future. Nothing lasts forever. We have to weather the storm. We have to prepare. We have to engage. And with God's help, I believe we can get back onto that mountain again. I thank you very much for your time.
Thank you so much, Mr. Winston. We appreciate your time and we'll hope that you stay on the call. We'll just move on to our next speaker. For the participants, we noted your questions and we'll take them right after our last speaker speaks. So speaking next is Dr. Marlene Street Forrest. As the saying goes, follow who knows streets. So those who have been through a debt exchange program will just speak to us a bit. Madam Dr. Marlene Street Forrest is the Managing Director of the Jamaica Stock Exchange and Director of both its subsidiaries, Jamaica's Central Securities Depository and the Jamaica Social Stock Exchange. She has been recognized as an iconic leader of the government of Jamaica, and today she'll be speaking to us on assessing the effectiveness of debt restructuring and its impact on the financial sector. Dr. Marlene, if you're on the call, please let us hear you.
Good morning, everyone. Are you hearing me?
Yes, please, we can hear you.
Yes. Okay, so I am really happy to be here this morning and to speak to you about assessing the effectiveness of our debt restructuring. I think that this is very important to you at this time. Let me thank Black Star Group for inviting me to participate in this critical and timely webinar and for the opportunities to share our experience. As you probably know, we have had two major debt exchanges, one that was launched in 2010 and the other which was launched in 2013. Now, our debt exchange that was launched in 2010 was really pushed because of our debt to GDP at the end of 2009, where our debt to GDP was 135%. Now, obviously, that is unsustainable. I'm aware that this will be of significant interest to you in Ghana as you currently navigate the path to restructure your domestic and external debts, which, as I understand, is a condition set by the International Monetary Fund for a $3 billion bailout secured in May of this year. I want to continue where Mr. Nelson left off, because he indicated that you have to understand the problem. You have to look at behavioral changes. You have to look at new products and innovate, influence policy, and engage stakeholders. And these are some core principles that must be applied after you, well, even before, but certainly after you have had your debt restructuring. The narrative for this, for our restructuring and the conditions for lending and the reasons for this action is only too familiar with the Jamaican government or people, and especially the financial sector. When in 2010, we embarked on the first $700 billion exchange program, which was called the Jamaica debt exchange. And I heard Mr. Nelson speak about a point that you don't want to go there and have to go there again. No, that was not the case. That was the case with the Jamaican government. We went in 2010, and then we had to go back with the National Debt Exchange, where the entire marketable Jamaican securities of 860 billion was the subject again of an exchange. I wish to borrow from the Financial Times of 2013, which summed up where we were at that time at the last exchange. And they said, Jamaican government is fighting to restore credibility with markets for a second time in 3 years to stave off economic crisis. And this was a position that we faced while all bondholders at the point decided they were going to accept the debt restructuring. We did not have a haircut, but we did accept the restructuring of the debt, longer tenures, etc. But what is most critical, I think, is a statement during that time that was made by the then Finance Minister, Dr. Peter Phillip. And he said that the new program consists of front-loading, sweeping actions by the government, combined with an outside stakeholder monitoring process and an internal implementation process. He further pointed out that the more fundamental reason for the comprehensive move was that politically and financially, Jamaica could not contemplate failure. So, you know, you are down in the valley, you want to go back up to the mountain, you cannot contemplate failure. And that is where we were, needing to take a comprehensive look at our fiscal and monetary frameworks, our governance, and I want to underscore governance structure, and our benchmark requirements to improve our financial and economic conditions. You may be facing similar situations that we faced at the time as well, because we had reduced tax revenue, we had unsustainable debt dynamics, mainly due to bunching of maturities of these bonds, increased financing risk due to short-term demand, increased domestic interest rate, and increased reliance on domestic financing, which crowded out the productive sector. And I heard, you know, listening to Mr. Nelson, that's the same thing we're talking about, the crowding out. And as a result of that, stymieing of innovation, because everybody gets lazy. And limited access, we had limited access to international capital. As a matter of fact, you know, when you look on what we had in terms of the rating agencies, the 3 major agencies rated us as a category C. And that is just one step away from the lowest rating of D, which says that, you know, we are at the bottom of the pile in terms of how markets saw us. And our debt at that time to GDP was over 140%. Is it therefore against that background that we must assess, back to the topic, the effectiveness of the debt restructuring and its impact on the financial sector? We must also bear in mind other key imperatives in Jamaica's move to restructure our debts and the background to the Jamaica economic program. And, you know, I want to state the economic program because it's not about just restructuring the debt, because it is a journey. It is not the buy all and end all. So some of our objectives was to raise real GDP growth, reduce, and a pillar for that was looking at the growth competitiveness and the ease of doing business. And second objective was that of reducing public debt ratio. And again, we had to look at what is a pillar in respect to this. It was looking at an active debt management program, because until you have that in place, the measurements, you can't measure, you don't know how to get in and out of positions. So the active debt management program was necessary. Then we had to look at another objective, was the fiscal discipline and accountability. Again, discipline, behavior change, as Mr. Nelson spoke to. And that we felt would allow for low cost multilateral and bilateral funding, which we were locked out of in terms of the cost of getting those sort of loan, or even just getting an engagement with the multilaterals and bilaterals. Then the next objective was that of maintaining fiscal stability. And the pillar that we looked at is fiscal consolidating strategies. So looking at strategies and structural and governance reform, definitely having to look again at how we change our behavior and also how we influence policy. I want to just go back to what Mr. Nelson said, because obviously these are some of the things that we need to do. We will return to see how we fared in respect to these objectives and pillars. However, I wish to allow you to put into perspective our most recent, and that is the one in 2013, and that's the NDX. In summary, the NDX involved 25 series of Jamaican dollar denominated securities, US dollar securities denominated, and inflation index bonds at various maturities. The country reduced the bonds from 25 to 21. I heard again referencing to Mr. Nelson about Singapore, less amounts, but deeper in terms of those bonds. Well, we reduced from 25 to 21. We lowered the coupon rate on the debt between 1% and 5%, and extended most of the maturities by 3 to 5 years. And in some cases, we extended it to 10 years. Our government also set a goal of having debt to GDP ratio of 95% within 7 years. That was down from 140%. And before the COVID, and I know everyone was impacted by COVID, before that COVID, we moved from the 140% that I spoke about when we had that crisis in 2013, when we did the debt exchange, to 94.26%. But it inched up naturally, I think, to 109.68% in 2020 during the COVID period. And currently, so we are talking about impact of the debt exchange. Currently, we are in July 2023 at 77.1% debt to GDP. And we're expected to have that reduced further to 60% by 2028. What have we done? The government has maintained a tight rein on its fiscal and monetary policies. And in a recent review by Fitch, so I'm going back to where we were in 2013, where we were at C. And in a recent review by Fitch, that's a rating agency, it summarized what we have done, and in giving us in April an outlook, which was revised from stable to positive. So we are at B, reflects our significant progress with debt restructuring despite COVID-19 pandemic shock. The report speaks to our stability-oriented institutional framework, because obviously we looked at our framework and how we were going to improve on that. And the favorable financing, so having had the debt restructuring in 2013, that's the NDX, the last one, we have been able now to have favorable financing conditions, including our most recent IMF facility. And the IMF facility that we have now, really what it is standby. It is in relation more to looking at climate resilient activities, which is important as we mature our environment. Public debt has fallen again following the temporary increase in 2020, as I said. Our B+ rating is supported by the World Bank. So we're talking about the various rating agencies looking at us and saying we are now a B+, which is really, in terms of the rating, attractive. There are still issues that are dogging us, I must say, for us to get the best results out of the restructuring exercise. And these are high crime rate, which we have to work on, low productivity, which is still a factor, and it is going to take time. We know, especially having slept for so many years with this high debt, which was mopping up productivity, and we have weak demographics. These have resulted in low single-digit prospect for growth. Fitch projects, based on the objective that the Jamaican government has set and the actualization of the core elements of our plan, a decline in debt to GDP of 78% by 2023 and around 70% in 2026. But obviously, we are still working on our target of 60% that we set ourselves for 2028, even though they think that it is challenging. We are pursuing our fundamental plans. And so, for example, one of the objects of the restructuring that I spoke earlier about was that of raising the real GDP growth, and a pillar on which it sits was improving competitiveness. So obviously you have your objectives, you have the pillars, and one of those was improving the competitiveness and ease of doing business. Jamaica has moved up from 71, the 71st place, to 64 in the world, which puts us as first in the Caribbean in respect to the ease of doing business, and 6th in the Latin American and the Caribbean region. So you can see that the breathing space that we have got, as I said, it's not a one-time event, it is a journey. And the decisions and the pain and the process that we have taken to improve our ease of doing business, that is a positive step in terms of having that debt restructuring as well. It cannot be overstated that the mere debt restructuring is not the be-all and end-all of the Jamaica program, which is not called the Jamaica Debt Restructuring Program, but the Jamaica Economic Program, as the debt speaks to just one limb, with others playing an active role in us not having to traverse the road of debt restructuring another time. Primary debt surpluses are expected to be the key driver in our debt decline, which must be put in the context of Jamaica's now strong stability and economic policy framework built on 2 pillars: inflation targeting, monetary policy, and fiscal policies anchored on debt restructuring targets. Now, what are our results? I've spoke to some of them earlier, but the government has built a record of fiscal prudence that has gained credibility in recent years. I'd like to strongly posit, though, that this has not been a government effort solely, but has been grounded and assisted by the people of Jamaica. A key committee that has kept successive governments accountable is what we call the Economic Program Oversight Committee, or EPOC, which was established in 2013. I don't know what you have done in wake of the your debt exchange, but what I feel was very important and still very important to us was that committee, the Economic Program Oversight Committee. And what it was established to do was to monitor fiscal, monetary, and financial indicators. It was established also to help with the implementation of Jamaica's economic reform under its 2013 agreement with the IMF. The committee comprises, and very critical to the composition, and that's, I'm going to go back to Mr. Nelson, engaging of stakeholders. Critical to that was the composition, which was private sector, public sector, and civil society. All have, and you notice I say have, not had, all having a part to play in the committee. The committee mandate has a mandate to advise the public of any concerns or development through traditional and digital media, and they have been doing that consistently. Quite recently, the country was pleased to hear of the results of how we are doing from EPOC. We are pleased with EPOC, and we are also pleased with the results that they gave to us. The following are the highlights, and they have indicated that inflation rate continues to trend downward at 6.1%. And that is just outside of the Bank of Jamaica is our central bank. And this is just outside of the Bank of Jamaica's target range. If you remember earlier, I said one of the limbs or the pillars was that of inflation targeting. And we are at 6.1%. And in earlier days, the inflation rate was double digits. Our tax revenue grew year over year and exceeded year-to-date target. That's important again. So the heavy reliance on debt to fund our activities of the government is reduced significantly, while our expenditure grew about 26.1%. It was as a result of adjustment, public sector adjustment in compensation. Our people held strain in terms of compensation until we were better able to increase and look at an overall reform. And that expenditure went up, but our net international reserve remains strong. And as Jamaica kick off the IMF program, this new one that I spoke to you about, we have exceeded our quantitative targets, and we are meeting all structural benchmarks. Our GDP grew by 4.2% for the first quarter in 2023, and it surpassed, importantly, our COVID levels. And the debt to GDP exceeded target of the 79.7% to close at 77.1%, down from 94.2% the fiscal year 2021-2022. That is the report of the EPOC, a body that we feel is there to shed light on how we are doing. While this is a snapshot in time, it really speaks to our sustained growth and fiscal management since the debt exchange and during and post the debt exchange program. In summary, since the debt exchange, Jamaica has raised real GDP growth rate, reduced public debt ratio, improved our fiscal discipline and accountability, and has maintained financial stability. And this is despite the fact that we have had political changes, because what we have done, we are committed in terms of how we need to change our behavior. We are committed to the fact that we could not and cannot continue the way we were operating. In reviewing our pillars, we have improved on our ease of doing business. We have instituted through the Bank of Jamaica, and that's our central, the Central Securities Depository. and the JCSD Trustee Services, and I'm happy to say that that is a subsidiary of the Jamaica Stock Exchange. What we have done, we have instituted through these institutions, arrangements, and other measures to look at and pursue active debt management program. So you can track, if you are looking at repo, how that sits with the underlying security, that there's not over trading of those securities, etc. We have been able to attract low-cost multilateral and bilateral funding, and our fiscal consolidation strategies and structural and government reforms are positive and ongoing. The financial markets, I want to speak to that because this is a financial conference. The financial market has benefited as well from the government reduced appetite for debt at exorbitant interest rates, which crowded out the productive sector. This has created a nimbleness, because obviously after debt restructuring, you have to think, what are you going to give in terms of yields, etc., to your investors? So what has happened is that this window, this breathing space, has created a nimbleness and rethinking in the sector for new products and services. That's the innovation part, and has reshaped research, innovation, and sustainability. The success has moved the financial sector out of the comatose state, and the reduction in interest rate have allowed the sector to lend at attractive rates, thereby improving productivity, competition, and positive returns on investments. Benchmarking to 2011, I must speak to that because I'm from the stock exchange, right? So I'm going to just talk about a little about the stock exchange, and then I'll wrap up. Benchmarking to 2011, the stock exchange has seen an increase in the demand and access to equity capital, and every offer to the market has been oversubscribed. You would not have that before debt exchange because persons would have been able to get, it's about options. Persons would have been able to get interest rates at an exorbitant amount. When with this and the lowering of the government rates, what we see is that persons started to look at, accessing equity capital and allowing the private sector to put those funds into production, allowing for competitiveness, etc. And you could see in terms of the balance sheet, the income statements of companies that are listed on the exchange, that this assisted in their growth and sustainability. Coinciding with the last debt exchange in 2013, the stock exchange recorded exponential growth, and we can track the consistency of our performance from the 2009 Jamaica Debt Exchange until the NDX and beyond. In 1997 to 2008, very significant, a low of 45 companies were listed on the exchange, with today over 100 companies comprising 145 securities now listed on the market. Our combined index moved from 97,000 in 2011. So I'm going a little back from the NDX and a little forward from the JDX. So it has moved in 2011 from 97, and you know what the index represent, 97,134 to 368,591 in 2022. Volumes traded increased by nearly 500%, and value traded increased from 21 billion to 56 billion. So there now the breathing space and activities that started to, unfold in the market. The debt exchange is not an end game, nor a panacea. in that it on itself cannot bear fruit. It's just one limb in a total fiscal and economic reform program. It, however, provides the breathing space and room for resuscitation, recovery, and growth if coupled with the necessary monetary and fiscal policies and governance arrangements and the buy-in, that is the stakeholder engagement and the ability to influence policies and commitment from a country on the way forward. Let me close by taking this opportunity to wish your country well as you embark on your own journey. The journey, we have seen other countries traverse this journey. There will be no doubt some pitfall along the way, but the saying goes that it does not take a rocket scientist to learn from others' mistake. So as we report a successful report today on our debt exchange, even without consent from any, I am able to say that in the event that you would like to speak with us further on our own programs, if you find that necessary, we are all game. And again, I say all the best to you.
Thank you, Dr. Street Forest. I think we're going to need your well wishes. You brought to life a lot of the things that we want to see happening in our country at the moment. So thank you very much. We have a ton of questions for you. And I have one question, but it's into like 3 different parts. So I'm just going to go ahead and ask. So the first part is to ask on, I know you mentioned that you had about 99% participation in your debt exchange. The first question is, for those who did not participate, how did you handle that?
Okay, so for those persons who did not participate, the decision was taken nonetheless to utilize the same measure that we, in terms of the swap. So they were allowed, and I use the term allowed in quote, they were given the same treatment as those who participated.
Sure, that's interesting. So the next question will be, what was the secondary market experience after the restructuring, and how was the behavioral changes with each of the participants?
I didn't hear the first part of the question. What was the market?
The secondary market.
The secondary market. Okay. So
yes.
What was the secondary market experience? Please
yes,
repeat.
Yes, in terms of trading.
Yes. What was the secondary market experience? And you are talking about for the bonds on the market. The government bonds?
Yes, please.
Yes.
Yes,
so
please.
So the secondary market trading, we still had active trading in those government bonds that were restructured. If you will recall that I said that the fixed income market dwarfs the equities market, and obviously the players in the market still depended on that as a part of the livelihood of the financial sector. So there was not a dampening in the secondary market activities. I think there was renewed confidence in those securities, and the market continued to trade effectively. one of the things that we, as a part of the arrangement with the IMF was that we had to put in place a trustee services arrangement, which I spoke about with the JSSD trustee area. And what we found is that all those securities would have to be put within a trust format in terms of the trading and the repoing of those securities. And we found that that worked well. So I would say that we did not have any negative trading. If we were to speak about it from a market restructuring, I think that persons were comfortable with where we were, even though, as you know, it was a reduced interest rate. It impacted pension funds, etc. But trading continued to be in those.
I just want to ask, I just have one more question and then I'll pass on to Asian. So
Yes.
just in case your market hadn't been as optimal as it was
Yes.
during that time. So if you, right now our markets are quite down.
Yes.
So what would you have done different if your market was similar to ours?
So your market in the trading of bonds is down at this point. Is that what you're saying?
Yes.
You know, there is a point, and you would have gone through, just correct me if I'm wrong here. You have gone through already your debt restructuring.
So we've
Or
gone
not
through
quite.
the CD1, there's CD
Yes.
bonds,
Yes.
and we are currently going through a restructuring of the local dollar and then the cocoa bonds.
Yes, I read about the cocoa bonds. So if the market is down at this point as it relates to the debt, the trading of government bonds, I think you have to explore other options in the market in terms of growth. The equities market is a prime example of how to look at diversifications for your various stakeholders, for your various investors. And as I raised the example of what was done in order to look at other avenues for investors in terms of their portfolios, etc. And our stock market created some avenue for that.
Thank you so much. I also have a few questions. You made a point about the restructuring being just a leaf in the book, meaning
Yes.
that there are other things that our government would have to do to ensure that the success of the debt restructuring. I mean, mention of fiscal adjustments that the Jamaican government did. What fiscal adjustments exactly? I know you mentioned that compensations were reduced, but were there any other where total government expenditure cut down? And
Yes.
what were the main pointers for the fiscal consolidation?
Okay, so as you have indicated, the government had to look at the compensation. Compensation was one of the biggest part of the expenditure in terms of the government. So what we looked at was a complete wage reform in terms of how we were going to be looking at compensation for government. We also reduced, which was part of what we had to do. So we reduced government spending on things like road work, etc. Those are some of the things that we looked at reducing in terms of the budget. The other things that we looked at in that period was how best we could collect our taxes. So tax reform was part of what we also looked at, how to get revenues in. We also looked at not only tax reform in terms of getting those revenue in, but we did look at our GCT, and that's the government consumption tax. We did not, as I recall it, no, we did not increase that. But what we did was to look at PAYE, and that's pay as you earn direct taxation, and that we did some adjustment to that at an increased level. So these are some of the things that we looked at.
Thank you for that. In terms of government raising capital, how were they doing? Were they still issuing treasury bills? And how was participation from the investors, the investor community?
Yes, government still raised capital through the treasury bills, but obviously in keeping with the entire reform, the rates for 180-day, 360-day was significantly reduced, but that it was another avenue for raising capital. But I think in terms of as I said, the cooperation with, if there is no other port in call, investors would still mop up those treasury bills. So yes, there was a treasury bill raising capital through treasuries.
Okay.
But at a lower rate.
Yeah, thank you so much. I think in our case as a country, we interest rates dropped temporarily at a point, but they started to climb back up again. And I believe that the government to take a cue from these discussions and then sort of reform some of our debt T-bill rates and then bring them in check. Thank you so much. We'll just take a few questions for Mr. Winston as well. Mr. Winston, please confirm if you are still on the call.
I'm still here.
Okay, there are a few questions for you. So the first is, would you say improper benchmarking led to the chase of high yields in our bond markets or portfolios not being valued at fair value?
Well, I think it's a combination of both. I think it's a combination of both. Interest rates are set by demand and supply. So we got to a point where we had a lot of pooled funds coming through because of the Pensions Act. And naturally, everybody wants the highest returns, okay? Remember that interest rates then at some point was quite high and it fell sharply. So almost all the bonds were being traded around, issued around 80, somewhere around there. But despite all that, it was so difficult to, I know that government expressed interest to bring it down further. So we saw it come close to 16 and then started going back up again. But investors at some point were also putting a lot of pressure on funds to say that we want better yields, because naturally they are looking at the absolute values of what they are receiving. So I think it's a combination of both that has led to where we are presently.
In light of that, Mr. Winston, do you think market will force the government to borrow cheaper because high yields will affect portfolio valuations?
Well, I think the mark to market is actually meant for to bring stability to the funds, and then to let investors understand the risk they are taking. So let's look at it in that framework. Mainly to bring stability to the funds in the sense that you don't have that false sense that every bond is worth the face value. Okay. Sometimes it can go below face value and it can go be high value. Portfolios are marked correctly. If you are exiting, you exit at the right price. So these are some of the things that is just being introduced by mark to market. Okay. So these are some of the key things that mark to market kind of introduces into the system.
Okay. So this is a personal question. So is the association looking at I mean, after post GDEP, there have been, and the market to market issue, investors have been very concerned about the value of their investment. Is the association looking at doing some sensitization or education? Is there a plan to ensure that investors are abreast with some of the developments on the market and ensure that they know what exactly they are getting into? That, as you just mentioned, their investments may go down, they may go up depending on the market conditions.
Well, absolutely. I mean, in the thick of mark to market, I mentioned it when I was earlier in my presentation. The association and the SEC were on radio, and the target was really investors to let them understand that fixed income does not properly work the way you have always believed it works. There are risks associated with it, and that is why we are doing this whole mark to market. We had also planned some sensitization. We had also planned some sensitization around, I think, just before the DDE program started. So we just felt that it wasn't the right time to do it because there was a lot of noise. This year, what we are planning to do, our Capital Market Week is usually in the first week of October. Once we join the Capital Market Week, there's a day that has been set aside just to approach investors, where we would have an open forum with them. We will have discussions. We're trying to explain what this whole thing has come up, give them an avenue to vent. Then hopefully when we are all leaving that place, we all agree to change our behavior for the security of our own future.
Thank you. I think we are looking forward to the Capital Markets Week.
Yes, Mr. Nelson, I have 3 questions here for you. The first question is on T-bills. Speaking about how high the rates are going. So just for you to reiterate, what kind of risk financial sector players need to keep in mind? And then the second question is on your comments on the number of bonds that should be trading in the market. And the participants asked that in the US, there are hundreds of bonds and it gives better liquidity to the market. So why shouldn't we mimic that? And then the third question is on mutual funds and mark to market. In terms of the fact that people are using different bonds to market. So going from institution to institution, you keep getting different values for your investment.
Okay, now, Louisa, thank you very much. So I'll deal with the first one, which is in terms of the T-bills. I think that is one issue that has come up a lot. We've had discussions with the ministry on the issue. Ideally, if we had a normal market, you expect that the T-bills will be behind what they know in terms of yields, behind what the longer dated bonds are. Unfortunately, we have it differently, because as we speak now, that is really the primary way government is raising money. So it has to pay, what would we say is the fairest rate it can pay for new cash to be able to finance economic activity. So I believe that down the line, the T-bill rates will correct once the government comes back into the market and starts to issue. Remember that the DDEP is not over. Currently, we are still doing another set of restructuring. The only challenge is that the market is a big fragmented. You have the general bonds, you have the individual, you have the pension bonds, you have pension industry bonds, all sorts of securities in the market. So I'm still a firm believer in that we have the minds to resolve all these issues. Let the DDEP let us be able to complete this program successfully. Once we do, through new issues, some of these problems can easily be corrected. So that is my view on the T-bills. If the question specifically is about will government default on it, well, I cannot look into a crystal ball. All I know is that they have said that they are not going to. For us to believe them or otherwise, it is every investor's choice and their appetite to risk. In terms of the number of bonds, you know, the US market naturally is, let me say, is a very developed market. It has been doing these things for hundreds of years. We are a market, we are quite young, we are now growing. The challenge when you have a whole lot of bonds so close to each other, it is difficult to undertake a benchmark program. Okay, very difficult to come up with an objective benchmark. At some point, when we had a 62 bonds, you could have 2 years, you have 13 bonds in 2 years, you have another 15 in 3 years, you have another 16 in 5 years. If you want to draw a yield curve, okay, the key thing for you to be able to draw a proper yield curve will be that you have a bond that is large enough, okay? It has to be large enough, and it has to stand out of that bucket of bonds. We didn't have any of those things. Once we were looking at remember I told you about the benchmark program that we were looking about 8 bonds. And that is just to be able to draw the yield curve. So they were tailored towards a 2, 3, 5, 7, 10, 12, somewhere there. That doesn't mean that no new bonds are going to be issued outside that. However, we were not looking at those who become the benchmark bonds. But we were not looking at government doing more than 2 other bonds on each point of the curve, because our market is currently evolving, is now developing. So we have to support it with these parameters for it to grow. It will bring liquidity, it will bring debt, it will improve pricing. There were benefits of us having a strong, properly drawn yield curve in the market. And that was what this was tailored towards. In terms of different people using different prices, I don't know. You know, the SEC came up with the guidelines, and the guidelines was clear on what to use to mark your portfolios. If you are a capital market operator, I don't think you can mark your portfolio differently than what the SEC has said. The only challenge, which we all agree and admit, and it has come through the association as well, is that the GIFIM closing price methodology, remember that was developed, that was communicated to the market. The criteria is objective enough. We know that it is robust. The challenge is that it is finding itself in a market that is not normal. And therefore, everybody is behaving differently. There are old bonds, there are new bonds, there are pension bonds, there are different types of bonds. Ideally, this will work. Ideally, this will work in a market which is a bit more structured. But given the environment in which we find ourselves in, that is why we are having this problem. GIFIM has tried to work with the PDs who quote the prices to be able to reach a certain understanding so that the swings are not too wide. I believe that several meetings have been held and some form of understanding has been reached. So I'm expecting that going forward, the price volatility in terms of the closing price narrows. It will reflect what the reality is so that people will feel comfortable and encouraged to use those prices. But in terms of if you're a capital market operator, the regulator is clear on what prices you use to mark to market. Thank you.
Thank you so much, Mr. Winston. Thank you for drawing the curtain on today's discussions. There was one more question which I'll take. The question was with respect to investments in foreign assets, and Blackstar remains your partner in all investment aspects, brokerage, asset management, advisory. We are here to assist. Our contact will be shared in the chat box and also on the screen briefly. To our participants, thank you so much for joining today's call. We appreciate your time and your efforts. For those who have been joining us since day one on Tuesday, we We appreciate that you keep faith with us and you've been on this journey with us. We conclude tomorrow. We acknowledge that it's a holiday, however, it must be done, So tomorrow we look at the fintech and then the SME space. We have Mr. Kenneth Ashibe, who will be speaking on the development in the fintech space and how they are going to broaden that space. We would appreciate it if you could all join the call same time tomorrow as we wrap up on the Blackstar Investor webinar series. Thank you so much and enjoy the rest of your day. Bye-bye.